Most people think they have bad credit because they don't make enough money, but that's not why your score is low. Folks, I want to tell you something that might shock you. Bad credit has almost nothing to do with how much money you earn. I've seen people making 6 figures a year who have terrible credit. I've seen folks just starting out with a modest income who have excellent credit. That's because your credit score isn't a measure of your wealth or your income level. It's a measure of your behavior. It's a grade you get on how you handle other people's money. It tells lenders, landlords, employers how reliable you are when you borrow. It's a trust score, plain and simple. So, let's stop this myth right now, that you need a huge salary to have a good credit score. That's just not true. The whole credit system is designed to measure one thing: how you manage debt. It's about your relationship with borrowed money. Think about it like a report card for your financial habits. When you pay your bills on time, you get a good grade. When you are late, you get a bad grade. It's not complicated. A credit score is a number, usually between 300 and 850, that summarizes all of this information for anyone who might be considering lending you money. This number can have a huge impact on your life. It can determine whether you get a loan for a car. It can determine whether you get a mortgage for a house. It can determine whether you get an apartment you want to rent. A higher score means you look like a responsible borrower, which opens up more opportunities. A high credit score can save you a lot of money in the long run. When banks and lenders see a good score, they see a low-risk customer. Because you've proven you're reliable, they are willing to offer you better deals. This usually means a lower interest rate on your loans. A lower interest rate means you pay less money over the life of the loan. On the flip side, a low credit score signals high risk. Lenders will charge you a higher interest rate. Lenders might just deny your application altogether. It's their way of protecting themselves, but it means your debt will cost you more. Your behavior with debt directly impacts your wallet. So the first step is to understand what this game is all about. It's not about being rich. It's about being responsible. It's about showing the world that when you make a promise to pay someone back, you keep that promise. That's the foundation of a good credit score. It's built on trust and consistency, not on the size of your paycheck. Once you grasp this simple truth, you're already on the right path to taking control of your financial life. You can stop feeling like you're behind because of your income. Start focusing on the simple daily habits that actually build a strong credit history. It is about your actions, not your assets. Now let's pull back the curtain and look at what actually makes up this magic number. It's not some big secret formula locked away in a vault. The credit bureaus are pretty open about the 5 main ingredients that go into your score. The biggest and most important one: payment history. About 35% of your score. This is just a record of whether you pay your bills on time. Every single late payment can knock your score down. The later it is, the worse the damage. On the other hand, a long history of on-time payments is the best thing you can do for your score. It's the heavyweight champion of your credit report. The second most important factor is credit utilization. That's just a fancy term for how much of your available credit you're using. This accounts for about 30% of your score. Let's say you have a credit card with a $1,000 limit. If you have a balance of $500 on that card, your utilization is 50%. If you have a balance of $300, your utilization is 30%. If you have a balance of $100, your utilization is 10%. Lenders get nervous when they see high utilization. It can look like you're overextended and relying too much on debt. A good rule of thumb is to keep your utilization below 30% across all your cards. Getting it even lower, say under 10%, is even better for your score. Next up, accounting for about 15% of your score is the length of your credit history. Lenders like to see a long track record of responsible borrowing. This is why you should reconsider closing an old credit card account even if you don't use it frequently. That old account is contributing to the average age of your credit history. When it comes to building credit, time is a valuable ally. Finally, we have 2 smaller factors that each make up about 10% of your score. The first is your credit mix: revolving credit, credit cards, and installment loans like a car loan or student loan. You don't need to go out and get a bunch of different loans just for this reason, but having a healthy mix can give your score a little boost. The last factor is new credit inquiries. When you apply for a new loan or a new credit card, the lender pulls your credit report, which creates a hard inquiry. Too many of these, in a short period, can make you look desperate for credit and can temporarily lower your score. If this helped you understand credit a little better, hit like and subscribe, because I'm going to keep breaking this stuff down in a way that actually makes sense.